Hey everyone, John Green here, and today we're diving into the exciting world of accounting. Okay, maybe not as exciting as a whirlwind adventure through time, but trust me, this stuff is important. We're talking about IFRS 3 business combinations. It sounds complicated, but it's really all about what happens when companies decide to join forces. Think of it like this. You've got two separate puzzle pieces, and when they come together, they form a bigger, more complete picture. That's kind of what happens in a business combination. Two companies merge to create something new and hopefully even more awesome. But just like with any big decision, there are rules and guidelines to follow. That's where IFRS 3 comes in. It's like the rule book for business combinations, making sure everything is accounted for correctly and everyone's on the same page. Why should you care? Well, whether you're a budding entrepreneur, an investor trying to make smart decisions, or just someone who likes to understand how the business world works, IFRS 3 matters. It helps to ensure transparency and fairness, which ultimately benefits everyone involved. So, what exactly is a business combination? In simple terms, it's when one company gains control over another company. This can happen in a few different ways, like a merger, where two companies combine to form a brand new company, or an acquisition, where one company buys out another. Imagine your favorite ice cream shop decides to merge with a chocolate factory. Suddenly, you've got a mega company that produces both delicious ice cream and mouth-watering chocolate. That's a business combination in action. Now, when these companies combine, their financial statements need to reflect this change. That's where IFRS 3 steps in, providing a set of rules for how to account for the assets, liabilities, and everything else that comes with the merging companies. It's all about creating a clear and accurate picture of the new, combined entity. IFRS 3 has some pretty important goals. Firstly, it aims to ensure that financial statements provide a true and fair view of the business combination. This means accurately reflecting the economic substance of the transaction and presenting a clear picture of the combined company's financial position. Secondly, IFRS 3 promotes transparency and comparability. By setting out clear guidelines for accounting for business combinations, it helps investors and other stakeholders to understand the financial impact of the transaction and compare different companies on a level playing field. This transparency is crucial for making informed investment decisions and fostering trust in the market. Think of IFRS 3 as a referee in a sports game. Just like the referee ensures fair play and enforces the rules, IFRS 3 ensures that business combinations are accounted for fairly and transparently. This helps to create a level playing field for all stakeholders and promotes confidence in the financial markets. To achieve its goals, IFRS 3 uses something called the acquisition method. Don't worry, it's not as intimidating as it sounds. Think of it like baking a cake. You need to follow specific steps in a certain order to get that delicious end result. The acquisition method has 4 main steps. Step 1. Identify the acquirer. This step is all about figuring out who's in charge, who's the boss, the head honcho of the new combined company. It's usually pretty obvious. The company that's doing the buying or merging is the acquirer. Step 2. Determine the acquisition date. This is the day the magic happens, the day the two companies officially become one. It's important to pinpoint this date because it's the starting point for all the financial reporting that comes after. Step 3. Recognize and measure assets and liabilities at fair value. Imagine you're buying a used car. You wouldn't just take the seller's word for how much it's worth, right? You'd want to get it appraised to determine its fair market value. It's the same with business combinations. We need to figure out the fair value of all the assets and liabilities that the acquirer is getting its hands on. Step 4. Recognize goodwill or gain from bargain purchase. This is where things get interesting. Sometimes, the price a company pays for another company is higher than the fair value of its identifiable net assets. This excess is called goodwill. Think of it as the value of the acquired company's brand name, customer relationships, or other intangible assets. On the flip side, sometimes a company gets a steal of a deal and acquires another company for less than the fair value of its net assets. This is called a gain from a bargain purchase. It's like finding a $100 bill on the sidewalk. Goodwill and bargain purchases are important concepts in IFRS 3. Goodwill represents the future economic benefits that the acquirer expects to receive from the acquired company's intangible assets. It's an asset, just like a building or a machine, but it's not a physical thing you can touch. Bargain purchases, on the other hand, are rare, but can happen in situations where the seller is under pressure to sell quickly or the market undervalues the acquired company. When a bargain purchase occurs, the acquirer recognizes the gain immediately in its profit or loss. Understanding goodwill and bargain purchases is crucial for investors because they provide insights into the financial health and future prospects of the combined company. High goodwill can indicate that the acquirer paid a premium for the acquired company, while a bargain purchase might suggest that the acquirer got a great deal. After a business combination, companies are required to disclose a whole bunch of information in their financial statements. This is all about transparency and making sure that investors and other stakeholders have a clear understanding of what went down. Some of the key disclosures include information about the acquirer and the acquiree, the acquisition date, the fair value of the consideration transferred, the reasons for the business combination, and the expected benefits of the combination. These disclosures help investors and other stakeholders to assess the financial impact of the business combination, understand the rationale behind the transaction, and evaluate the potential risks and rewards. It's all about keeping things open and honest.